Today, we're diving into three big stories in the market that you don't want to miss. First, Google. This tech giant is making headlines again, but not for the reasons you hope. The Department of Justice is ramping up its antitrust efforts, demanding the breakup of Google's core business. Yes, Chrome might have to go. With the stock sliding recently, I want to dig into whether the market is overreacting or if there's a real threat to this AI and search leader. Next up, Target. The company just reported earnings, and let's say it wasn't pretty. Shares dropped over 20% in a single day after management gave weak guidance for the all-important holiday season. Target has been under pressure for months, but now it's reaching valuation levels we haven't seen in years. The big question is this screaming buy for long-term investors or a value trap for when it catches you off guard? And finally, Domino's Pizza, a stock you probably weren't expecting to hear about today, but when Warren Buffett makes a move, aka Berkshire Hathaway, you have to pay attention. The Oracle of Omaha recently added Dominos to his portfolio, and that has people wondering, what does Buffett see in a pizza company? With its focus on delivery, innovation, and franchise-driven growth, Domino's has quietly become one of the most consistent cash-generating businesses on the market. Three very different stories, but all of them tie back to one question: so do you invest? I'll share what I'm seeing in the numbers, the risk, and the opportunities for each, and whether they're worth adding to your portfolio. And I'll also discuss what's in my portfolio and keep it real and transparent. So let's go ahead and get started. First, I want to start with Google. And wow, there's a lot going on with this company right now. The Department of Justice is back at it, demanding Google sell off Chrome. Yes, Chrome, the browser that most of us use every day without even thinking about it. The DOJ is framing this as a big step to increase competition, but honestly, I don't think anyone's asking for this. Who's out there saying, man, I really wish Chrome didn't exist? Probably no one. But let's set the headlines aside for a second and look at the bigger picture. Google isn't just a browser or a search engine. It's the internet for most people. Between Google, search, YouTube, Gmail, Maps, and even Android, it's almost impossible to go a day without using something they own. And that's exactly why regulators are so interested. They see Google as too big, too dominant, and too powerful. But I have to ask, are they punishing Google for being good at what they do? Because the reality is, people choose Google products because they work. They're not forced into it. They prefer it. Now, about this whole antitrust situation, the market clearly doesn't love it. The stock has been hit hard, and investors are worried about what breaking up parts of Google could mean for its business. And look, I get it. The idea of splitting up such a massive, complex company can feel like uncharted territory. But here's the thing, this isn't Google's first rodeo. They faced regulatory scrutiny for years, and yet here they are, still one of the most dominant companies in the world. And right now, they're kind of affordable. Take Microsoft, for example. They went through their own antitrust nightmare in the late 90s. Everyone thought it would be the end of them. Instead, they emerged stronger, more diversified, and more valuable than ever. Google might be heading down a similar path. The DOJ might create some hurdles, but it's hard to see how this fundamentally damages Google's core business. In fact, even if they did have to sell off Chrome or another division, some of Google's parts might actually be worth more than the whole. It's a weird thought, but sometimes breaking things up unlocks value. Let's not forget about Google's financials, because this is where things get really interesting. Right now, Google is trading at a forward price to earnings ratio of 19.4. That's the cheapest out of all the big tech companies. Compare that to Apple or Microsoft, both trading at around 31, or even Amazon sitting at 34. Google is not just undervalued, it's seriously undervalued, and it's not like the business is slowing down. Last year, they pulled in over $280 billion in revenue and maintaining an operating margin north of 25%. That's insane for a company of this size. What really caught my attention though is their cloud division. Google Cloud brought in over $8 billion in revenue in the last quarter alone, growing 22% year over year. And then there's YouTube, which is basically a money printing machine. People think of YouTube as just a platform for creators, but it's so much more than that. It's a search engine, a social network, and an entertainment hub all rolled into one. And now with YouTube Premium, they're adding another layer of recurring revenue that's only going to grow over time. But let's talk about the elephant in the room, AI. This is where Google really shines. They've been investing in AI for years, and it's starting to pay off in ways that most people don't even realize. Google Bard, their chatbot competitor to ChatGPT, is already making waves. And then there's DeepMind, which is light years ahead of most competitors when it comes to AI research. If AI is the future, Google's already there. Here's what I find fascinating. Google isn't just using AI internally, they're monetizing it. Google Cloud, for example, is essentially an AI powerhouse. Companies are paying billions to use Google's AI tools to analyze data, predict trends, and optimize their operations. It's a high margin business that only is going to go up and get bigger as more companies adopt to AI. Now let's zoom out for a moment. Why is Google so undervalued right now? It's fear of regulation, fear of competition, and fear of change. But as Warren Buffett likes to say, be fearful when others are greedy, and greedy when others are fearful. That fear is creating an opportunity for long-term investors. Google is still a dominant, cash-generating machine with massive growth potential. The risks are real, but they're not too damaging. Think about it this way. Even if the DOJ gets their way and forces Google to make changes, the core business isn't going anywhere. Search is still king, YouTube is still growing, cloud is becoming a bigger piece of the pie, and AI, that's going to be one of their biggest growth drivers over the next decade. The fundamentals are rock solid and the valuation is just too good to ignore because it's pricing in the threat of them having to sell Chrome, right? So here's where I stand. I think the market is overreacting. Yes, the regulatory pressure is a headache, and yes, there's some uncertainty about how it will all play out. But if you take a step back and look at the big picture, Google's future is still incredibly bright. This is a company that's built to last, and at these prices, I see it as a long-term opportunity. Well, what about you? Are you buying the dip, or do you think the risks are too high? Let me know your thoughts in the comments below. Moving on, let's talk about Domino's Pizza. A company I never thought I'd be this interested in. I'm pizza. How exciting can that be, right? But then you hear Warren Buffett, the oracle of Omaha himself, is buying into Domino's, and suddenly, you have to take a closer look. Buffett doesn't invest in flashy tech, speculative plays. He goes for reliable, cash-generating businesses. So, what does he see in Domino's, and is it worth our attention? That's what we're unpacking here. Now, when you think about Domino's, you might picture the app or a late-night delivery, but this isn't just a pizza company. It's an operations machine. Over 70% of its revenue comes from franchises, which means Domino's collects fees without having to run most of the stores themselves. It's a low-risk, high-margin setup that's perfect for generating steady cash flow. And here's the kicker. Domino's doesn't just operate in the US, it's in over 90 countries. The international presence gives them a diverse revenue stream, something most companies in this space can't claim. But what really sets Domino's apart is its relentless focus on technology and innovation. Remember a few years ago when they introduced the pizza tracker? That was a revolutionary thing at the time, and now they're leading the charge on delivery automation, using AI and even testing self-driving delivery vehicles. They've also doubled down on carryout options, which are higher margin sales for the company. This constant push to stay ahead is why Domino's has remained a leader, while competitors like Papa John's and Pizza Hut have struggled to keep up. Let's talk numbers because this is where things get interesting. Domino's has been a steady performer for years, even during tough economic times. Their franchise model generates consistent free cash flow, and their use that to reward shareholders with buybacks and dividend growth. They're a great dividend growth company, which is what I love to see. Right now, their dividend yield sits at around 1.5%, and while that might not sound massive, it's backed by solid earnings growth. Domino's has also managed to grow its earnings per share consistently over the past decade, which is why it's favorable for long-term investors. What really caught my attention is that Domino's thrives in both good and bad economies. When things are good, people are happy to splurge on convenience. When times are tough, pizza is an affordable comfort food that fits tight budgets. It's what Buffett loves, a simple, predictable business with a moat. Their delivery network, technological edge, and massive scale make it nearly impossible for smaller competitors to replicate their success. Personally, I don't think Domino's has a huge moat right now because there's Pizza Hut, Papa John's, Little Caesars. They definitely have competitors, but Domino's has definitely scaled the largest right now. But I want to be honest, Domino's isn't a cheap stock. It's trading at a premium valuation, reflecting its stability and growth prospects. The question is whether Buffett's interest signals there is still room to run. Personally, I think this is one of those companies you buy and hold. It's not going to double overnight, but it's the kind of stock you look back on in 10 years and think, why didn't I buy more? What about you? Do you see Domino's as a slice of stability in your portfolio? Let me know in the comments. Personally, I don't own any of it, but I am eyeing it. Another company I don't own but has some news lately is Target, a company that's been in the headlines for all the wrong reasons. After their latest earnings report, the stock dropped more than 20% in a single day. That's not just a bad day, it's a sign that something's fundamentally off. And it makes you wonder, is Target just a victim of tough economy, or is there something deeper going on? Target has always been one of those retailers that feels like it knows its customers. It's not as no frills as Walmart, but it's not trying to be a luxury store either. They've built this weird niche where they offer affordable products that look and feel a little more premium, and for a long time that strategy worked. Their private label brands like Cat and Jack for kids and Good and Gather for groceries have been huge hits. I mean, how many have you gone to Target for a couple things and walked out with a cart full of stuff you didn't even know you needed? That's the magic of Target until it isn't, and we're going to discuss what's wrong with it. The problem now is that the economy has shifted, and Target hasn't shifted with it. With inflation still biting and interest rates squeezing budgets, people are cutting back on discretionary spending, things like clothing, home decor, and electronics, and that's where Target thrives. And it's probably why they missed huge on their earnings and why such a company like them dropped 20% in one day. In contrast, Walmart is crushing it because they focus on essentials like groceries, which people buy no matter what. Walmart has that ultra low price advantage that Target just can't match. And Amazon, they're a beast of their own. Even in tough times, people are glued to Prime for the convenience and fast delivery. Target finds itself stuck in the middle. It's not cheap enough to compete with Walmart, and it doesn't have the same convenience edges as Amazon. Let's not forget some self-inflicted wounds. Earlier this year, they struggled with inventory issues and missteps in product choices, which alienated parts of their core customer base. It's like they lost their balance. Now, here's where things get interesting. At its current price, Target stock is trading at a forward PE of about 14, well below its historical average. That's pretty cheap, especially for a company with a 3.5% dividend yield. But a low valuation alone doesn't make it a buy. Target needs to show it can fix these issues, adjust to changing consumer behavior, tighten up operations, and carve out a clear identity in a crowded retail space. For me, Target is a company I'm keeping an eye on, but I'm not rushing into it yet. I just think other companies in my portfolio are better suited for me and can grow bigger over time, and I still think Target's one of them. It feels like there's potential, but I need to see signs that they're turning things around before I buy. What about you? Is this a buy on a dip opportunity? Do you own Target? I'd be very interested to know in the comments. That's going to wrap things up for this video. Hope you enjoyed, and I'll see you in the next one.